Believe it or not, we have all just lived through the worst 6-month collapse of the US dollar in over 50 years. So in today's video, I want to share with you what just happened and how we can all look at that in a way that benefits us. So let's jump in. We're going to start off with this New York Times article, and it's called, the title is "The Dollar Had Its Worst Start to a Year Since 1973." And there's this great chart. It doesn't share good information, but it's very useful. This shows the first 6 months of every year going back to 1986. What happened to the US dollar? And unfortunately, you can see the red line there. That is the first 6 months of 2025. You can see we're down almost 11%. And the author says the last time the dollar weakened so much at the start of the year was 1973, after the United States had made a seismic shift that had ended the linking of the dollar to the price of gold. I mean, that was a major, major shock to the world system. It was not something that was communicated broadly ahead of time. It was kind of announced. It was kind of shock and awe. And it caused the entire world to kind of rethink how to value US assets, how to value the US dollar. So to think that we're in this place now, frankly, was surprising to me. I knew the dollar was down about 10%, but I didn't know that the last time that happened over a 6-month period was when we moved away from the gold standard. Okay, this is not a political channel. I'm going to share what the author says about what caused this, but more importantly, how we can all benefit. So the reporter goes on to say higher tariffs likely mean lower imports, which makes sense, and lower imports mean fewer US dollars being paid to businesses overseas. I agree with that. That in turn could reduce dollars reinvested back into the United States in markets like the government bonds that we issue to pay down our debt. That makes sense to me as well. Now, so how do we make lemonade out of these lemons? Here's what the author says. For American investors, the weaker dollar can encourage looking outside of the United States, I'll add, for investments. Then he gives the example, the Stoxx 600 index, a broad measure across European stocks, has risen roughly 15% over this same time period, but converted back in the US dollars, see how it almost increases it by 10 percentage points. Instead of 15%, when you convert that back to US dollars, it's a return for American investors of 23%. So, and this gets to a fundamental thing. How do you make lemonade out of lemons? The way you do that is you prepare for it years ahead of time. The way you prepare for it years ahead of time is by having a diversified portfolio. Oftentimes people will ask me, "Hey, Azul, why don't I just invest in the S&P 500?" And while that would have been a great move over the last 25 or 30 years, the reality is the S&P 500 has done very, very well. The question for you and I, when you look at your portfolio and say, should I just be in the S&P 500? The question going forward is, how much risk are you taking? What kind of negative years might the S&P 500 have? And what kind of return, what kind of reward are you going to get for that? And for many of us, being able to maintain our peace of mind when the stock market's doing poorly is really important. And that's one of the values of a diversified portfolio. For a long, long time, foreign stocks international stocks have been out of favor with American investors. And the reason is they've outperformed the S&P 500. But you can see here, the Stoxx 600, think of that as it's not an equivalent to the US S&P 500, but it might be considered a close cousin to that. And so you can see it's up 23% for people that invested US dollars. Now it can cut the other way too, right? If the US dollar comes all the way back up in the next 6 months, that's going to hurt people. But that's why we have a diversified portfolio, because none of us can predict when things like this are going to happen. And so we want to be in a situation where we can win when things like that happen. And I'm going to share with you another investment that typically does well when the US dollar goes down in value, But before I do, I just want to share and build on this thought of the importance of a diversified portfolio, the importance of having a plan, the importance of having your asset allocation. What percent of your portfolio is in stocks and what percent are in bonds, or how many years worth of living expenses could you live on high quality, short duration bonds that hopefully won't move up and down as much as the stock market. And so how do you do that? The gold standard, I think, is to work with a fiduciary financial advisor. I know many of my viewers are never going to do that. And if that's you, I urge you, instead of using Google Sheets or Excel, use software designed to help you think through things like this, designed to help you plan. The software that I like is called Bolden. It used to be New Retirement. If you go to this QR code here to sign up, you'll be supporting the channel. I am an affiliate, or you can go to the link below. Okay, what's the other investment that tends to do well when the US dollar is down? And none of this is investment advice. None of this, I don't know your situation. I don't give investment advice. Um, but I do think, my investment advice is have a good asset allocation and to work with a professional to get. But something that tends to go up, at least historically, past performance is no guarantee, are commodity prices. Commodities are traded on a worldwide stage. So as the US dollar decreases in value, oftentimes the value of those commodities go up, um, just for purchase parity across different countries. And so there could be a nice tailwind coming. Now, commodities can be very risky investments. Foreign stocks can be very risky investments. US stocks can be risky investments. So it's important that you really give a lot of thought to how you're invested. First, your asset allocation is likely going to determine the vast majority of your success as an investor. And your asset allocation is not likely to change based on 1 or 2 years. It's much more likely to change based on changes in your life events. For instance, once you quit work and once you quit having a salary coming in twice a month, unfortunately, our risk, I just retired a year ago myself, our risk tolerance changes. And the pain of a 20% stock market loss or a 30 or a 40% loss goes up, and it can go up quite dramatically. And that increased pain of stock market losses can lead us to be, for emotional reasons, forced sellers in a down market. After a couple weeks of worrying when the market goes down and not being able to sleep and being worried about, what does this mean to your financial plan? After a couple weeks of that, sometimes people capitulate and say, I just can't take the pain anymore. And unfortunately, we become forced sellers. Our emotions make us forced sellers. I don't want to see that happen to you, which is why I think you should have a good financial plan. You should have a good asset allocation. Again, if you're going to do it yourself, the software that I like is called Bolden. And if you enjoyed this video, the next video of mine that I think you should watch next is why waiting to 65 might be a big mistake. You can watch the video here. Thanks for watching this one. Bye-bye.